My name is Nicole Kaeding, and I'm the Director of Special Projects at the Tax Foundation based in Washington, D.C. You've actually just given me a nice overview of what I'm going to be covering. In particular, I'm going to actually spend some time going through the numbers from the Institute of Taxation and Economic Policy, ITEP, that I'm sure Carl's going to talk about some, and Lisa's shown you guys a lot as well. I have some thoughts on their numbers, particularly I think they actually overstate the regressivity in their tax code, and I want to kind of walk you through why I say that. So I'll spend some time on my numbers, but also kind of dissect their numbers as well. And then we'll talk about tax triggers and some of the lessons from other states and some ways that I think that you all should be thinking about them as you design tax triggers. If we think about kind of this overarching discussion you guys have had for really the last year, 18 months, every conversation involves these kind of first principles. How do we design a state tax code? And unfortunately, every tax code, every tax policy, and this applies to every policy area as well, we're looking at trade-offs. And there's no perfect way to do this. There's no 100% right way. It's how do you balance all of these various things at the same time. So when I'm thinking about tax policy, right, what am I thinking about? I'm thinking about this idea of neutrality. Are similarly situated taxpayers being treated similarly, right? Do we provide an incentive to one type of firm and not another type of firm? How do we balance that across industries and across the economy? We're looking at things like simplicity, right? Is it fairly easy to complete your state tax return? Is it easy to comply with? And it's also, is it easy for the state and DFA sit behind? Is it easy for them to administer? We're looking at transparency. Do individuals and corporations and businesses in your state get how taxes work, right? Is it easy to understand? Are we hiding taxes or are we making them visible to individuals? We're looking at stability. You obviously want to ensure that your revenue base is producing a stable amount of revenue. You don't want to interject a lot of volatility because that makes your job so much harder on the spending side of the equation. And then we're looking at retroactivity, which I think is going to be a big conversation when you guys get to the Wayfair conversation today. But we ideally don't want a tax code that makes changes that happen in the past. You don't want to punish behavior that's already happened, but you also don't want to structure a tax code that tries to incent behavior that's already happened. And unfortunately, that also sometimes happens. So we're looking at all of those things at one time. And every single person is going to have a slightly different way that they weigh these sorts of trade-offs. But when we're talking about regressivity, we're talking in a large way two other concepts. And it's these ideas that as an economist we call horizontal equity and vertical equity. So horizontal equity is this idea that two taxpayers each making $50,000, are they paying functionally the same amount of taxes? And if they're not, then perhaps the horizontal equity needs to be revisited. And then regressivity largely gets this idea of vertical equity. Are those the lower end of the income spectrum and those at the higher end of the income spectrum, what does their tax burdens look like in comparison to each other? So obviously, as you guys decide in August what these final recommendations look like, you have to be looking at all of these various principles at the same time. And we've talked about these a lot through the last 6 months in particular, but we'll kind of focus a bit more on this idea of vertical equity or regressivity. In addition, I want to make sure that this is clear. Categorizing a tax as regressive or progressive or proportional isn't an all-or-nothing thing. So we talk about, for instances, and we'll see this a lot, particularly the ITEP data, sales taxes tend to be perceived as being regressive. And that's the idea that individuals at the lower end of the income spectrum are going to spend more of their incomes than those at the higher end who are going to be saving as a percentage more. But how you assess the sales tax also drives that conversation. Assessing a sales tax on something like grocery items is going to probably be a bit more regressive than assessing a sales tax perhaps on landscaping services. assessing them on goods versus, services, right? There's going to be a bit of distinction here as well. So we can't just say like this tax is regressive or this tax is progressive or this tax is proportional. You also have to look a bit in how the tax works and how it functions. As a tax foundation, we don't have a specific measure of regressivity. I think that, again, there's just a lot of different trade-offs here. But the closest proxy that we have is our state local tax burdens report, which we've talked about before. But what we're doing here is a few things. The U.S. Census Bureau has 26 different types of state and local taxes that it reports data on. We take those 26 different types of taxes, some of the big ones, right? Sales taxes, corporate income, property. Some of them are very, very small, right? Gambling, per state. We take all of those, but then we also account for shifts across state lines. We'll talk about this a bit more as well with ITEX again. And as an economist, I discuss this as being a tax as being exported. Sometimes the people who pay your tax are not people in your state. Great example. I've been traveling down here often to Arkansas. I do not live in the state of Arkansas, but I have paid sales taxes in the state of Arkansas. You all are collecting revenue from my travels. But the economic burden of that tax actually doesn't reside here in Arkansas, it actually resides in Washington, D.C. Another example, we could think about if we all collectively decided to transport ourselves right now to the state of Florida and go to Disney World. We would all be paying sales taxes to the state of Florida. On the Mickey Mouse ears that we buy, the hotel rooms that we have to stay in, the rental cars, the food, etc. But the economic burden of that tax is here. This happens also on the business side of the equation. If you look at revenue collections per capita, Alaska's top 1, top 2. Alaskans don't pay most of their taxes because their revenues come from oil and natural gas extraction. The gasoline that you put in your car this morning, you paid Alaska's taxes, functionally, right? There's this distinction.